I've bought 4 investment properties in my 20s, so here are my thoughts around the pros of buying an investment property for yourself. Number 1, less risk and volatility. Generally speaking, property investing is actually considered to be less riskier as opposed to investing in other assets like ETFs or stocks. Regardless of the ups and downs of the market and the economy, generally what you'll tend to find is that property seems to perform better and you're able to have a higher amount of capital growth occur over the same period of time if you compare that to ETFs as well. It is also said that property works as a hedge against inflation. So what that means is that when inflation is high, the value of your home also increases. However, for you to see the full benefits of this, usually your loans would have to be interest only, or they would have to be fixed, and also your property should be bought in the correct market conditions for you to see those benefits. Now, for your property to do well, it is dependent on a few factors. One being location, secondly, being the research that has been conducted to figure out the best possible investment for yourself, and also depending on the time that you actually purchase these investments. Personally, what I tend to do, because it is very hard for me to manage my work and also sitting and doing my own research, I tend to outsource this to a buyer's agent, and lucky for me, my partner is one as well. If you are interested in finding a buyer's agent, I will leave his links down below in the description box so you can check out his services. And if you're like me and you don't have the time or the energy, or you have the know-how to find a property that is going to make sense logically with numbers, then preferably seeing a buyer's agent would be your best bet. I bought my first investment property in 2020 at the age of 24, 25 years old, and I have personally not seen my property decline even during periods of the pandemic. In fact, I've actually been able to refinance my existing property and that loan and extract some equity so that I could purchase my subsequent properties and not have to put anything out of my own pocket or my savings. It's a great hack for anyone if you are looking at building your property portfolio just to leverage bank debt. Now, in most cases, we all know that buying your first investment property is the hardest one to get, but once you get the ball rolling and you've settled on your first property, purchasing the subsequent ones after that becomes a breeze. 2, increase your income. You're able to earn rental income if your property is tenanted out, especially if it is a positive cash flow property. So this essentially means from all the rent that you receive from your property minus all of the cost is your profit, is the cash flow that you have. Now, this profit can actually be treated as income, and you can use this income to build your investment portfolio and propel your investing journey. Now, being in your 20s, you obviously want to diversify your investments, and you may want to perhaps travel, you may want to start a business or a side hustle, and having that additional income from that investment property is actually quite beneficial for you. And as Warren Buffett says, never depend on a single income. Make investments to create a second source. If you think about it, we tend to put all of our eggs in one basket, and having one source of income like your 9-to-5 job can be quite risky because everything is relying on that source of income. Say, for example, you lose your job one day or you're not able to work and something happens to you, then essentially your form of income coming into your household is vanished straight away. So you want to make sure that you are building multiple streams of income, and property investing is a great way to do that. 3, perks of capital growth. If your property increases in value, then you will benefit from capital gains. This is calculated by what you paid for the property minus what you sold it for, and then this gives you the profits. Now, there's a good quote by Harv Eker who says, "Don't wait to buy real estate, buy real estate and then wait." Essentially what he means by this is to don't hold off on property investing. The sooner you start, the quicker that you get into the market and have your foot through the door, the better it is going to be for you in the long term, because over time, land value appreciates, house prices are appreciating, and you're going to be able to have more money in the form of equity building over time for you to use later on in your life for either retirement or just general living expenses. The advantage of being younger is that you've honestly got more time in the market to recoup and gain the benefits of the market cycles for much more years to come, as opposed to someone who is only starting to invest at the age of maybe 40, 50 or 60 years old. My first investment property was bought for $237,000, and I've recently got it revalued and it's coming back at $450,000, which is a profit of about $213,000 in just under 3 years. I then used those funds to to allow me to purchase more investment properties. So essentially I was just repeating the cycle over and over again to build my property portfolio. 4, tax benefits. You're able to get tax deductions when you decide to offset your property expenses against the rental income. The benefit of this is that it actually pushes your taxable income lower. This can also be sometimes referred to as negative gearing, but I would personally suggest speaking to an accountant. So let me give you a brief example. If you earn $80,000 from your day job and you own a rental property, and let's say that the property earns about $20,000 in rental income that year, but let's say that the costs like the interest and the running costs that are used to manage that property equate to about $30,000 that year, you have essentially made a $10K loss on that property. So what this means is that $10K loss can actually be used against your taxable income. So that can bring your taxable income from $80,000 to $70,000 because of that $10K loss that you experience, which essentially saves you tax. So instead of taking up a lower paying job and not accepting that promotion because you fear that you're going to fall into the next tax bracket, but instead if you buy a property and put that money towards something productive and something with capital growth, this also has benefits even if your property is negative cash flow. Number 5, capitalize on free bank debt. This is actually a concept that I've actually heard from Rich Dad, Poor Dad. It's a book that I'm currently reading at the moment. So if you want to learn more about leveraging bank debt to benefit you financially, I'll have the book linked down below in the description box so you can check it out. So what it means to leverage bank debt is when you use the bank for its debt, i.e. a loan, to purchase for an investment property. And if you decide to wait a couple of years, let the market do its thing, let the land value appreciate, your house value appreciate, you'll then be able to refinance that loan with another bank and you'll be able to extract some equity from there. And then you can use that equity, like I mentioned before, to just repeat and rinse that cycle again and again over to build your investment portfolio. Of course, you need to be mindful that your serviceability does allow for this as well. So what that means is whether you can actually service the loan and you can afford the loan and the repayments. So generally what the bank will ask you is, what additional forms of income do you have to increase your borrowing capacity so that you can actually build on your investment portfolio? Also, the benefit is that when you're in your 20s, you'll be trying everything to increase your salary by taking up a promotion, by maybe changing jobs to increase your salary, perhaps starting a business or a side hustle, because generating more income helps you in taking on more productive debt so that you can build on your investment portfolio. Number 6, pay off your mortgage faster. The earlier that you start with property investing, the quicker you can actually pay off your mortgage. Usually mortgage terms are about 25 to 30 years. So if you start at the age of 25, you'll have your mortgage paid off by the age of 50. A recent study was conducted which stated that 62% of senior Australians were worried that their retirement savings would run out. And one way to ensure that you've got enough money during your retirement years is to make sure that you invest in property at a young age. This way you have more time for the equity or the value in your property to grow over time. And sometimes what people do is that they sell their homes when they near the retirement age and possibly maybe start renting, and then they can use all the funds that have been accumulated or built up into their house and use that for their retirement, and they can live a comfortable retirement. And a hack which I personally learned and what I personally do is that instead of buying one large investment property, what you can do is purchase a few smaller investment properties so the barriers of entry are also smaller as well. And think about it, you may not even need to take up a mortgage, which is considered unproductive debt, especially if you don't have rental income coming through. For example, buying your first home and being an owner-occupier, you yourself are having to pay for the repayments, and there's a lot of risk involved with that. But if you've got multiple investments, you've got tenants who are paying your mortgage for you, and when it comes time to retirement or when it comes time to buying your dream house, if you've started investing early, you'll be able to sell off those investments that you've got and they would have appreciated over time. Then you can buy perhaps your dream house outright without even having a mortgage for about 25-30 years. Number 7, high income and low expenses. Starting to invest into a property at a younger age is much easier because you've got lower expenses, you've got little to no responsibilities, you have a low chance of taking care of dependents, there's no one really relying on you to provide for them, so that you can focus on building your wealth, earning a higher income, working, and being able to purchase investments that actually benefit you later down the track, which can help reduce your overall financial stress when you do get older. So if you found this video informative and helpful, please do give this video a thumbs up, and please subscribe to my channel and follow me over on my Instagram and my TikTok, and I will see you guys in my next video. Thanks guys.